JPMorgan says a cascade of margin calls is coming and might have already started, guys. We're going to talk about what are the factors that I am personally looking at for indications of margin calls, and we are getting some right now, and specifically how these margin calls could affect stocks like AMC with a high short interest and that have fundamentals that are improving, meaning the short thesis is getting worse and worse by the day, week, month, and year, guys. So if this is your kind of content, if this is your first time here, consider sticking around a while and hitting that like button and subscribing to the channel now so you don't forget to do so later on in the video. You know what I'm saying? Now, let's get straight into it, guys. So JPMorgan says a cascade of margin calls is coming, a lot of it due to what is going on in the crypto markets, and they even expect crypto to fall to in between 10 and 13,000 per coin for Bitcoin. And this is having some everlasting impacts, likely everlasting impacts, especially in your altcoin market, but as well as with the hedge fund lending industry. And one of the things we know is that there's a lot of manipulation around AMC, and there is a lot of this unending drive to short the stock no matter what is happening. Well, when you start to get billions of dollars of losses in the crypto markets as well as just overall in AMC, you can't forget, has rallied over 55% from the lows of 2022. That is obviously hurting the P&L if you are short in AMC, right? Unless you shorted a long time ago, which a lot of these hedge funds continue to pack on these short positions, you are definitely starting to feel the pinch there. And not to mention the cost of borrow rates and everything else we're going to talk about in this video. It looks very good for AMC, and maybe that's a reason why AMC has been holding up so well to begin with in the first place. Now, I first want to start off this video with the FINRA margin debt, because margin calls, margin debt, right? You can see the importance of that. And we just got some new numbers for October, and you're looking at about $649.5 billion currently worth of margin debt outstanding in the markets. Now, this was very interesting because you actually seen the lows of 2022 in October on October 13th, and it's been back up since then. So it's kind of weird how the dates actually fell, because literally almost halfway through the month, you've seen a really bad, first half and then a not so bad second half. Anyways, the margin debt went down about $15 billion, but given the extent of the drop you've seen in early October, it makes you wonder if the hedge funds are really at a very bad point during October, if they needed the markets to go up, because after all, trading algorithms, these computers, they do control the vast majority of trading. On any given day, depending if it's a low volume or high volume day, you could have, 60 to 85 or 90% of the volume actually being done by trading algorithms. Nevertheless, the margin still at $650 billion in this year, especially when you have seen massive losses in the crypto markets. Like, the overall loss is 70% market cap for crypto. Specific cryptos are down a lot more than that, and that's not even to mention the lending that has essentially evaporated and has been seen as losses, right? For any bank, for any hedge fund, which, granted, before I even say this, they have all been doing business in the crypto markets, they lost on all those investments. Like, they are all going to zero, and that's what is going to fuel a lot of these margin calls. And I'm not saying crypto is going to zero, I'm saying the lending behind crypto products, that's all a loss, right? All the banks were into that. All the hedge funds were into that. So when you think about this in the grand scope of where the margin debt currently sits, you're getting a lot of losses that are still not being reflected in the margin debt going down. To put this into perspective, since June, the margin debt was at $683 billion. It's now, call it $650 billion. It's only went down $33 billion in, the worst half of a year that you have seen in a very long time, those numbers just don't make sense to me. And with how over leveraged this market is, it's concentrated in a lot of specific sectors. And to think about how hedge funds, by and large, not retail investors, you might use margin for something different than a hedge fund does, or a trading firm, right? Well, they're using margin in places, especially in 2022, that are the hideout places. They're using margin in Apple. I'll tell you, they're margining the shit out of Apple. They have been throughout all of 2022. That's why the stock has been up so much, right? And it's a relatively safer stock to have some margin on. They were also margining out in the crypto markets, which that is completely went to shit. So we're not even going to talk about that. Continuing on this video, they have also been margining out in your value stocks, right? A big part of that was actually in oil. Virtually everyone was bullish on oil, and virtually no one seen this massive drop in the price of oil that we have recently seen. Like, nobody forecast this. People were expecting oil to hit $200 before it went back to $78 a barrel, right? There's been a massive drop in the price of oil during this same time in which hedge funds have had a lot of leverage in, because the fundamental picture for oil looks pretty good. You got, COVID lockdowns, which, once that reopens, potentially could have positive, negative impacts for the price of oil. But overall, that's been a very positive thing. And then you got the crisis with Russia, which is the main story of oil, right? There's just been a lack of a demand. You're heading into winter. It makes a lot of sense for oil to keep going up, in which it is not. And the price of oil going down will mean the price of these oil stocks also taking a hit, where a lot of the margin is concentrated. Margin is not concentrated in the NASDAQ stocks, at least for the second half of 2022. They might have got caught up in that in the first quarter, whatever. Trust me, it's not in the margin. It's not in the NASDAQ stocks. Margin is not in NASDAQ stocks. It's way too risky. Hedge funds, they're not going to do that. Where margin is used, I should say, is shorting those stocks. It's not on the long side. They're not buying these stocks, the margin. They're shorting these stocks with margin. And specifically, I want to focus on AMC. And you could lump AMC and what I'm about to say with other companies as well that have very high short interest, but also very rapidly improving fundamental businesses. There's not too many companies like that, but they are out there. And I think those are the ones that will benefit the most once you do start to see these massive rounds of margin calls. Because when you take out a short position on a stock, typically you need to put up collateral for that stock, right? If you start to get sloshed out in crypto, your safety stocks, your Apples, right? Granted, Apple is down 2% today. There is a lot of concerns about Apple's production and their fundamental valuation. From here, it doesn't look pretty. The COVID lockdowns doesn't look pretty for Apple. So they're getting sloshed on that. They're getting sloshed on crypto. They're getting sloshed on oil at this point. The last thing to really go is your healthcare stocks, your more recession-proof stocks, in which they will get sloshed as well very, very shortly, in my personal opinion. But nonetheless, I think the fundamentally sound or improving companies that have a high short interest, like AMC, are the ones that will get squeezed the most. Because when you look at your position as a hedge fund, I've said this many times, but you got to look out 3, 6, 12 months, because you don't want to be in a short position for years. That's the last thing you want to do. I think it's pretty safe to say the short thesis on AMC is not getting better, especially, I mean, you're having Amazon invest $1 billion for theatrical released movies alone. You're going to get more movies as film studios have been, basically delayed because of COVID. That has been a real thing. It takes about 2 years to, make a blockbuster movie. If COVID happened in 2022 and they were starting production, I mean, that's why you're starting to get more movies that will be going to theaters, throughout the rest of 2022 and throughout 2023 and 2024. before. So the thesis now shorting AMC makes absolutely no sense. And given what we have seen exterior to AMC with the markets, with the liquidity and the margin situation, I think you're more primed than ever to see shorts cover on their short positions. I think it will take something. It's going to take another event, another news catalyst, something, but you will start to see those margin calls, and you will actually see it reflected in the price action of AMC. Margin calls, they don't tend to be a slow and steady move up. They tend to be very violent, up 10% candles, down 5%, up 15. It tends to be very violent up and down until you do get that prolonged move to the upside. Nonetheless, let's run through the Ortex data, guys, and we could see the estimate of the dollar amount that is currently sold short in AMC has went up a lot recently at $804.5 million. Estimated short interest of free float has also went up a lot over the past week. And just so I don't have to repeat the same thing, all of this data has went up a lot over the past week. Some of these numbers double digits, like the days to cover. Some of these numbers in the high single digits, but they've all went pretty crazy over the last 2 days. It's been pretty phenomenal to actually see these numbers and where the estimates are going. But nonetheless, estimated short interest of free float at 21.29%, free float out on loan at about 35%, shares out on loan 180 million, days to cover at 7.1, cost to borrow at 35.8%, and 100% share utilization. And like you've heard a lot of times, 20% short interest is where it gets extreme. Anything over 20% is like super extreme. That's where you get vulnerable for short squeezes alone. And really anything over 10% short interest is vulnerable for a short squeeze. But AMC is a little bit different. It's been, a rapidly improving fundamental picture, especially since the last earnings. The last earnings were good, and typically you want to bet on stocks that have good earnings at least over the next 3 months. You tend to return a very positive return if you do that, especially stocks that had killer earnings like AMC did, and they also issued very good guidance for the next quarter, which I think will also be important. And if you look at the cost of borrow rates, the cost of borrow rates have been one of the main stories with AMC as of recently, and helps to just tie into this whole margin call situation. These rates have been super high, and that's obviously a very bad thing for hedge funds. Cost to borrow average sitting at about 50%, even going up since the last video that I made. That was about 45% in earlier today's video. Looking even better now. Cost to borrow max at 56%, cost to borrow minimum at about 28%. So overall, looking very good. And as far as the option activity for the day and where we ended up to wrap off trading, 55% positive order value, 7 orders totaling $6.35 million. And it looks like some hedge funds are starting to get ahead of this margin call situation, the price of the stock actually going up, because you're starting to see a lot more dollars head into AMC again, in which we have not seen in a long time. And they're starting to be a little bit more positive. For an example, over the past week, 57 orders have went into AMC stock. This is unusual or interesting option flow activity. These are from hedge funds, money managers, institutional investors, just large money, and they're going in as one order. So they're trying to get into these orders very quickly, and that is the unusual and interesting part about this option flow, and that's why it's a thing, right? Because it really goes to show, if hedge funds want to get into a position quickly, probably there's a reason for that, right? But nevertheless, 57 orders totaling $20.5 million, positive order value of 56%, and you might laugh at $20 million for last week in option activity, because a lot of people aren't going to talk about that, because AMC has been a lot higher in the past. It has been no thing to see $300 million worth of options placed on AMC in a week. But as of recently, the last couple of months, you've been at, $3, $4, $5, $6 million a week in institutional option activity. That has increased about 4 to 5x since the last couple of weeks in this past week. So I think it's telling you a lot, guys. And I think all of these things are pointing back to one thing: that AMC is going to go much higher. And if you do see margin calls, well, we could be looking at a pretty big situation here. And I think there's a lot of opportunity for AMC, for options, for buying shares. Just overall, I think we're at a better time than we have seen in a very long time to be long on AMC, especially if we can remain above that 50-day moving average, in which I've been talking about extensively here on this channel. If you get a break to the upside, that might be the confirmation that you need if you're waiting to see what's going to happen. That would be my confirmation. Nonetheless, that is it for this video. Hit that like button, subscribe to this channel, source your comments, questions, or concerns down below in the comment section. Thank you guys for watching, and I will see you in the next one.